Okay, let's talk about NXP Semiconductors. It is a massive $59 billion powerhouse, and yet it is somehow completely flying under the radar. Today, we're going to dive into this explainer and figure out why this might actually be the single most compelling physical AI play on the market right now. So to really get what we're looking at here, we kind of need to redefine what this company actually does. Because NXP is not your standard run-of-the-mill cloud computing chipmaker. Instead, they are what you'd call an edge intelligence infrastructure company. What does that actually mean? Well, think about a factory robot or a self-driving car. They literally can't afford to wait milliseconds for a cloud server somewhere to tell them to stop for an obstacle, right? They need to process that data instantly, right there on the edge of the network. And NXP is building the chips that make that possible. They connect the dots between raw sensors, instant processing, and physical action in the real world. And that brings up an incredibly important distinction. NXP is not Nvidia. While Nvidia is out there dominating those massive energy-hungry data centers and commanding dizzying, sky-high valuations, NXP is playing a completely different, much quieter game. They are focused exclusively on AI-enabled physical systems. Think of it this way. If Nvidia is the brain up in the cloud, NXP is the nervous system down in the car in the factory. It's a far less crowded infrastructure play, which gives us a much more reasonable entry point if you want exposure to AI without chasing all that mega-cap hype. Now, breaking down their projected $12.27 billion in 2025 revenue, their stronghold is immediately obvious. Automotive is their absolute heavyweight, claiming 58% of the whole pie. Industrial and IoT follow up at 19%, mobile at 13%, and communications sitting at 11%. Honestly, that heavy reliance on the automotive sector is a bit of a double-edged sword. It's their greatest competitive moat, absolutely, but it's also their biggest exposure. But the truly exciting narrative hidden in these numbers is that the business isn't just relying on cars anymore. We are actually seeing multiple business segments across this entire ecosystem recovering simultaneously. Here is where it gets really interesting. NXP's cyclical recovery isn't just some optimistic theory floating around. It is undeniably showing up right now in their Q2 2026 metrics. Look, the semiconductor industry is notoriously cyclical, right? It swings violently from massive supply gluts to incredible demand booms. For the last year or so, the broader industry was in a major slump. But the data is practically screaming that NXP has hit the bottom and firmly entered the highly lucrative recovery and acceleration phase of that cycle. Let's look at the hard evidence. They just reported nearly $3.5 billion in revenue for Q2. That is a massive 19% year-over-year jump. But honestly, what's even more impressive is the 10% sequential increase from just the previous quarter. In the software world, jumping 10% in 3 months is great, sure, but in a physical hardware business with crazy complex supply chains and manufacturing lead times, that kind of rapid acceleration is incredibly difficult to pull off. It absolutely proves that end market demand is rapidly thawing out. Now, this part is probably my favorite detail from the quarter. They didn't just boost top-line revenue, they simultaneously expanded their core gross margins to 58%. In the semiconductor space, companies can easily juice their revenue in the short term by slashing prices, basically destroying their own unit economics just to clear out inventory. NXP is doing the exact opposite. Seeing revenue climb while gross margins expand is literally the holy grail for a hardware business. It is the strongest possible signal that they have serious pricing power and that customers are willing to pay a premium for their highly differentiated products. So take that powerful combination of top-line revenue growth and margin expansion, and what do you get? A beautiful 33% year-over-year surge in earnings per share, hitting $3.61. For anyone doing a detailed analysis on this is the exact mathematical setup you want to see coming out of a cyclical downturn. You've got revenue growth multiplied by expanding profit margins, aided by targeted share repurchases. The end result is explosive bottom-line earnings that completely outpace the overall market. Add in a staggering $791 million in free cash flow for the quarter, and the financial picture just gets even better. Free cash flow is the lifeblood of any business. It's the actual cash left over after paying for operations and maintaining all that heavy equipment. Nearly 23% of NXP's revenue turns straight into cold, hard cash. And because NXP doesn't require the insane multi-billion-dollar capital expenditures of a company building massive AI data centers, they generated so much excess cash that they comfortably returned $360 million directly to shareholders through dividends and buybacks in just 3 months. So where is all this financial muscle coming from? It's built directly upon their massive $7.12 billion automotive moat. You have to realize the modern vehicle is undergoing a radical, once-in-a-century transformation right now.
We are rapidly shifting away from legacy cars that just had dozens of isolated, dumb computer chips and moving towards software-defined vehicles. These are essentially rolling supercomputers featuring centralized processing, high-speed internal networking, and over-the-air updates. And this massive architectural shift dramatically increases the sheer volume and complexity of the semiconductor content required inside every single vehicle rolling off the line.
Their competitive advantage isn't simply about etching the smallest transistor on a piece of silicon. It's deeply embedded in the harsh, physical realities of manufacturing. Automotive and industrial customers require unbreakable hardware-level security and incredibly intense engineering. Plus, these chips have to go through qualification cycles that literally take years. Once an NXP processor is finally certified and physically embedded into a carmaker's platform, that manufacturer is virtually locked in. I mean, they are highly unlikely to swap it out for a competitor just to save a few pennies per chip. The retesting, the software rewriting, the safety certification costs, it would be astronomical. And that creates incredibly sticky, long-term customer relationships.
As traditional machines evolve, NXP's hardware architecture perfectly supports the entire lifecycle of physical AI. Think about how a smart robot or an autonomous car actually operates in the real world. First, raw data comes in through sensors and radar. Second, it needs secure, ultra-fast connectivity to move that data. Third, NXP's edge processing takes over, allowing the actual AI inference to happen locally and instantly, without waiting for a cloud connection. And finally, that AI decision has to be translated into physical machine control, like literally hitting the brakes. NXP owns and secures its exact end-to-end hardware pipeline. And we are seeing this exact architecture successfully applied far beyond just cars. While the automotive segment grew a very solid 12% year-over-year in Q2, the industrial and IoT segment absolutely exploded by 38%. It is fast becoming the hidden gem of their entire portfolio. As smart factories, automated warehouse robotics, and massive industrial networking take off globally, this segment has the potential to dramatically diversify NXP's revenue streams. And eventually, that could force Wall Street to wake up and assign them a much higher valuation multiple. However, to remain completely objective and thorough in this analysis, we can't just wear rose-colored glasses. We absolutely must address the very real, very heavy risks challenging this bullish thesis. No investment exists in a vacuum, right? And NXP is currently navigating several macroeconomic and operational headwinds that demand some careful monitoring. First off, you have to closely monitor their heavy 58% reliance on global auto production. If EV demand stalls out or automakers slash their production targets, NXP's earnings will absolutely feel the pain, regardless of how well management executes. Additionally, there are intense geopolitical tensions and fierce domestic EV competition brewing in China, which is a vital market for them. Finally, you really need to pay close attention to channel inventory, which is the stock of chips just sitting in warehouses waiting to be sold. It has ticked up to 11 weeks, up from 9 weeks a year ago. If that inventory keeps climbing while end market demand slows down, we could be looking at another painful sector correction. So, with all that fundamental data firmly in mind, let's look at the actionable valuation framework. The stock is currently hovering around $233, which is roughly 31% off its 52-week highs. But more importantly, it's trading at about 20 times its trailing earnings. In a market where broader AI semiconductor companies are trading at dizzying multiples of 50, 60, or even 100 times earnings, a 20x multiple for a highly profitable, cash-flowing market leader presents a remarkably reasonable risk-to-reward profile for a long-term strategy. Breaking this down into a structured model, our analysis projects a bear case bottoming around $190 to $215. That happens if the global auto recovery heavily disappoints and operating margins retreat under pricing pressure. However, our base case, which is the most probable scenario, models a fair value target up to $310, assuming the automotive sector continues its steady recovery and margins organically approach 37%. Finally, the bull case envisions the stock surging toward $380. But for this to trigger, we need to see physical AI become highly commercialized and the mass adoption of software-defined vehicles accelerate dramatically. For the focused learner wanting to actually execute on this thesis, the preferred moderate accumulation strategy is highly structural to help manage risk. It suggests starting with a 40% allocation right now at current levels. But critically, you must deliberately reserve your capital to buy on weakness. If the price dips into the $215 to $225 range due to macro volatility, you add another 30%. The final 30% is deployed only after another strong quarterly earnings report confirms the thesis. And of course, all of this is while maintaining a strict, patient 3 to 5 year horizon. Which leaves us with one critical final question to consider. As artificial intelligence aggressively breaks out of those massive cloud data centers and begins taking physical shape in robots, smart factories, and autonomous vehicles, are you positioned in the companies actually building that real-world infrastructure? NXP's recovery has arrived, the cash flow is undeniable, and the physical AI revolution is really only just beginning. The question is, are you ready for it?